Welcome to the Deep Dive. We take complex information like earnings calls and break it down so you know exactly what's going on.
And today, we're definitely digging into a complex one. Acadia Healthcare, or ACHC, their Q2 2025 earnings.
Yeah, this one caused quite a stir. We need to understand why. The initial market reaction was, well, pretty brutal, wasn't it?
Oh, absolutely brutal. You had this strange situation. On one hand, really strong numbers reported big beats, but the market just hammered the stock, dropped nearly 17% on the day. Huge volume, too.
Okay, so that's the puzzle. A big beat meets a massive sell-off. Let's lay out the good news first, the actual results they posted for Q2.
Sure. So the top line revenue came in at $869.2 million. That's a solid 9.2% jump year over year, and it comfortably beat what analysts were expecting.
And the earnings story was similar, right? Adjusted EPS?
Even better, actually.
Yeah.
Adjusted EPS, the non-JAP number everyone watches, was $1.83. The consensus on the street was hovering around maybe $1.07, so a really significant beat there.
Okay, strong revenue, strong earnings. How did things look operationally, like within the facilities themselves?
Looked pretty healthy there, too, on the surface. Same facility revenue grew 9.5%. And what's interesting is how they got there. Revenue per patient day, so pricing power, was up a really strong 7.5%.
Wow, 7.5%.
Yeah, and patient days were also up by 1.8%. So more people coming through the door, and they're capturing more revenue per patient. Adjusted EBITDA also climbed $201.8 million for a margin of 23.2%. Pretty solid.
Right, so everything sounds great, stellar numbers. Why the disconnect? What was the specific thing that spooked investors so badly?
It really boiled down to one main thing, the updated guidance for the full year. That's where the pain point was.
The forward-looking statement.
Exactly. Despite crushing Q2, management set the midpoint for their full year 2025 adjusted EPS guidance at $2.52. And the street was expecting something closer to $2.62.
Hold on, a 7-cent difference in the full-year forecast caused a 17% stock drop. That feels disproportionate. The market must believe there's a deeper issue here, not just a small miss.
Well, yes. It signals pressure. And the market wants to know why there's pressure. The first big piece seems to be volume. They lowered the full-year guidance for same-facility volume growth.
Lowered it to what?
Down to a range of 2% to 3%. Before, they were talking low to mid-single digits. So a definite pullback in expectations there.
Okay, but is that volume slowdown across the board, or is it concentrated somewhere specific?
It's very concentrated. Management was quite clear about this. They pointed specifically to softer Medicaid volumes, particularly in their acute care segment.
And why are Medicaid volumes softer?
They put it down to, changing utilization patterns. Basically, managed Medicaid plans are getting tighter with approvals, trying to manage their own costs. That's creating friction.
Gotcha. So it's not like overall demand for behavioral health disappeared. In fact, didn't other payer types look pretty strong?
That's the contrast, yeah. While Medicaid was slightly down year over year in Q2, commercial volumes jumped 9%, and Medicare was up 8%. So people with commercial insurance or Medicare, still strong demand. The issue is very much focused on that managed Medicaid piece.
Okay, so you've got this specific volume headwind hitting right as the company is pushing hard on growth, adding beds.
Exactly. And that's their core strategy, capacity expansion. They added 101 beds just in Q2. That brings them to 479 beds added so far this year.
And they actually raised their target for the full year, didn't they?
They did. Now aiming for 950 to 1,000 new beds for the full year 2025. Accelerating the pace.
Normally, accelerating growth is a good sign, but opening new facilities costs money up front, right? Those startup losses.
And that's the other shoe dropping. Those startup losses are now expected to be higher for the full year. They guided to $65 million, which is about $10 million more than they previously expected.
Okay, let me see if I understand this. The market is punishing them partly because they're opening beds faster, pulling forward about $10 million in costs from 2026 into 2025.
That's essentially it. It hits the near-term earnings guidance, which is what the market reacted to so strongly. Management tried to spin it saying, look, this means 2026 startup losses will be lower, but the immediate hit to 2025 guidance overshadowed that.
Classic short-term focus. Okay, let's switch gears slightly. There was some positive news on the policy front, specifically out of Tennessee.
Yes, that was a significant positive. A newly approved supplemental payment program in Tennessee. It gave them a big one-time pre-tax benefit in Q2, about $51.8 million. That covered some past periods too, like FY24 and early 2025.
A one-time boost is nice, but does it continue?
That's the key part. Management expects it will continue, projecting a recurring net benefit of around $10 to $11 million per quarter for the rest of 2025. That's, some helpful, sticky revenue going forward.
Okay, good. And what about that other legislative thing, the Big Beautiful Bill Act, as you called it, potential work requirements, co-pays? Management seemed pretty calm about that. Why?
Right. Well, that's just our internal shorthand for various state or federal bills with those kinds of provisions. Management's confidence comes from their patient mix, meaning their core patients often have chronic substance use issues or really complex co-occurring medical and behavioral conditions. They believe these specific groups will likely have exemptions under such laws, so they don't expect things like work requirements or new co-pays to sort of materially impact their volumes.
Okay, so they feel somewhat insulated there. But even with strong underlying demand and maybe manageable policy risk, they still had some operational hiccups, right? Underperforming facilities.
Yeah, that was another drag. These specific facilities pulled down the overall same facility patient volume growth by about 80 basis points in Q2. And the financial hit from them is now expected to be worse for the full year.
How much worse?
They're now forecasting a $23 million EBITDA headwind for the full year 2025 from these specific sites. That's tougher than they initially thought.
Okay, $23 million hit there, plus the $10 million extra in startup costs. You can see how the profit pressure mounts, and it seems like that pressure forced a pretty big strategic change regarding spending.
It definitely looks that way. The CEO, Chris Hunter, talked about taking a harder look at capital spending, at CapEx. And the big move was pausing construction on 2 facilities that were already in their pipeline.
Pausing construction, how much does that save?
Over $100 million in CapEx over the next 2 years. It's a significant pullback on spending.
That feels like a major pivot. They were guiding to be free cash flow positive by the end of 2026. Is this purely about getting there faster, or is the market basically saying, we won't fund your aggressive growth anymore unless we see the cash?
I think it's largely the latter, influenced by the current market environment. The cost of capital's up, companies burning cash for growth are getting hammered. So pausing some CapEx is a direct way to accelerate getting to positive free cash flow. It's defensive. They're choosing near-term cash generation over maximizing future capacity right now.
So the investment story shifts. It's not just pure growth. It's growth plus show me the money, basically.
Pretty much. Cash conversion is suddenly front and center.
And on top of all that, you have some other issues hanging over the stock, like instability in the C-suite.
Right. The CFO, Heather Dixon, is leaving on August 15th. Tim Sides is stepping in as interim CFO. Look, a CFO change right when the market is questioning guidance and profitability, it just adds another layer of uncertainty. Not ideal timing.
Definitely not. And the other big overhang, those legal costs are eye-watering.
Yeah, $54 million spent just on legal fees in Q2. That's tied to the ongoing DOJ and SEC investigations. And it's crucial to remember that's just the legal expense. It doesn't include any potential settlement money down the line.
Oof. Did they give any indication of when those costs might ease up?
They did say they expect them to be lower in the second half of the year. But, it's still a significant cost and a source of risk until it's fully resolved.
Let's zoom out for a second. How has ACHC performed relative to its peers or the sector?
It's a stark contrast. The broader healthcare provider sector, like the IHF ETF, has actually had a great run recently, up over 17% in the last 3 months, ACHC, down about 2% in that same time frame.
Wow. So that really highlights it. The issues plaguing Acadia, the guidance, the FCF questions, the legal stuff, the CFO leaving, they are very specific to this company right now. It's not a sector-wide problem.
Exactly.
Yep.
And ironically, management actually reported some good news on the labor front. Wage inflation seems to be stabilizing around 3.5%, down from previous highs, and they're using less expensive premium labor. That should help margins eventually.
But the market isn't focused on eventually, it's focused on the now. The core tension seems to be management saying, trust our long-term growth plan, and the market saying, prove you can turn beds into cash now, especially with all this other noise.
That sums it up perfectly. And that CapEx pause is management's direct response to that market demand.
Okay, let's pivot to our This Is Not Financial Advice segment. Given everything we've discussed, the huge sell-off, the fear priced in, but also the underlying demand and that shift towards faster FCF, what's a potential trade idea here?
All right, so acknowledging the massive negativity baked in after that 17% drop, there's an argument that the core engine, the bed growth, the demand is still there. The big change is management explicitly trying to pull forward that free cash flow positive date.
So how do you play that potential turn?
Okay, again, not financial advice. But one idea could be a medium-term bullish options play, maybe looking at something like a deep-in-the-money call option or perhaps a call spread targeting an expiration out in, say, mid-2026.
Mid-2026. Why that time frame specifically?
Well, it gives the strategy time to work. It allows time for that accelerated free cash flow timeline driven by the CapEx pause to actually materialize and become evident in the numbers. It also provides runway for the legal and regulatory noise, those high legal fees, to hopefully subside in the second half of this year, like management predicts.
And for that Tennessee money to prove it's recurring.
Exactly. If those things happen, and if the core volume trends, especially in Medicaid, just stabilize, you could see a pretty significant re-rating of the stock, a multiple repair. The mid-2026 timeframe gives those catalysts room to play out.
Interesting. Leverage play on a potential turnaround driven by cash flow acceleration and clearing uncertainty. Okay, let's wrap this deep dive up.
So Acadia's Q2 2025, a real mixed bag, wasn't it? Strong reported numbers, yes, but overshadowed completely by weaker volume guidance, higher near-term costs from accelerated growth, and then the clouds of the CFO exit and those ongoing investigations.
The key takeaway for me is that strategic pivot. Management explicitly hitting the brakes on some spending to get to free cash flow positive sooner.
Which leaves us with a really interesting question for you, the listener, especially if you follow these high-growth healthcare providers. In today's market, what's more valuable for long-term valuation? Is it maximizing near-term cash flow, even if it means slowing growth? Or is it maximizing that future growth capacity, even if it means burning cash for longer?
Something to definitely think about. Thanks for diving deep with us today.